Welcome to Stocks in Translation, broadcasting from Yahoo Studios in New York. I'm Jared Blickery, and with me is the people's voice, who you know as Sydney Freed. Please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming JJ Kinahan. He's the CEO of IG North America. IG owns Tasty Trade and Tasty Live, so we've got some great insights into the retail trader. And today we're going to be talking about retail trends, markets in general, along with some options shop talk. Our phrase of the day, buy the dip. The strategy has worked well over this bull market. One question, is it still a good idea? And this episode is brought to you by the number 10%. That's how much the Mag 7 stocks as a group are down this year. And we're still in a bull market. How long can it last without the mega cap AI engine of growth? So, JJ, great to have you here. We're taping this as President Trump's tariffs are now real and getting bigger by the day, seemingly. So tell us how you're seeing the recent market action, where we've seen some weakness, admittedly.
Well, obviously, I think if we look at where the weakness has been, you covered it a little bit with the number 10 there in terms of the fact that the Mag 7, I think if you look at what are some big surprises for the year, I think if you were talking to anybody in January, they would have been like, oh my God, you got to double up on the Mag 7 because everything about what's going on there is going to be fantastic. And as we've seen, the only one truly holding their head up so far this year has been Meta in terms of positive territory. So with that, I think that, the buy the dip mentality is we want to work in the phrase of the day also,
Sure.
of course, is something that perhaps retail investors in particular have to be a little bit more careful of going right here. It has been an unbelievable strategy, let's be honest, for the last 4 years. And in fact, from the retail point of view, Jared, the one stock that's kind of been leading the way in the buy the dip has truly been Microsoft. It's the first place people tend to turn in terms of individual names when we have trouble. We are seeing that still, but the difference being we used to see Apple be a stock that people also turn to pretty quickly. Not seeing that as much recently. Meta taking the place a little bit, but at the end of the day, it tends to start with Microsoft from the retail perspective.
That is a fascinating insight, and we'll dig into that. And you set up perfectly our phrase of the day, so I'll break it down right now. Buy the dip. It's pretty straightforward. Buying the dip is a strategy of purchasing an asset after its price has dropped, believing that it's going to go higher. So I pulled up a Google Trends chart, and the phrase buy the dip seems to get its start during the original QE era following the global financial crisis. We're talking about 2010. It was definitely a meme. You guys might remember some videos from the era, and its popularity skyrocketed in 2020 over the pandemic. And then we also saw another surge in the GameStop Reddit era of 2021. And guess what? It fell off in the bear market of 2022, and now it's on the rise again. So JJ, it almost seems to me like buy the dip is a sentiment indicator in and of itself. What does it mean to you?
Yeah, actually, that's a great point. I do think it's a sentiment indicator. And when people think that, some trouble in the market is a temporary, if you see more people buying the dip, I think what they're really saying is we have confidence in the market overall longer term. We have confidence that we're going to see the bounce back. What's been very interesting to me, though, this last 2 weeks is if you think about the buy the dip mentality, one of the things that has often paid off for people is in that last half hour of trading on tough days, they come in to buy the dip and you see a bounce. You might see the S&P 500 bounce 20 points, bounce 25 points. You haven't seen that as much in these last couple of weeks. Looking at a day like yesterday and in terms of Tuesday, when many people may have done that, and the S&P 500 actually, we went from plus 10 points to minus 68, and it seemed like about 20 seconds. Obviously, it was more like 20 minutes. But that was a time after we had rallied all the way back from being down. Market looked like it had a lot of momentum. That is the thing you have to respect about the market. And if you just think buy the dip is always going to work, these last few weeks have proved why you have to always respect it.
JJ, how much of a decline does a dip make? Can you slap a number on it? Like if a stock closes down 0.1%, can I yell buy the dip? Or does it have to be more significant than that?
Yes, and I mean, I tend to think of a buy the dip being more like a 3 to 5% move to start. And I tend to look at it in the market overall or in those Mag 7 stocks that are highly correlated with the market. I think you have to be, buy the dip to me tends to be more of a bigger market event, bigger stocks, the S&P 500 or the NASDAQ 100. You have to be a little bit more careful if you're going to go to like name number 50 or name number 52. And you also have to be very careful if you're going to do it on bad news because of earnings, because that may stay with a little bit of a longer negative reaction than you may see just on an overall market move that's because of some news event.
And is it similar with like ETFs and mutual funds? Same advice there?
Yeah, absolutely. But, mutual funds, you don't normally hear buy the dip because I don't think people, one of the things about buy the dip, it's often used for shorter term trade. Some will use it for longer, but many also use it for shorter term trade when they think things have gotten overdone in a shorter period of time. And maybe they're playing for the next few hours, the next few days. With mutual funds, you normally don't have that kind of action. But certainly with ETFs, if you look at the SPDR or the QQQ, you will see exactly that type of action there.
JJ, you were just talking about the character of the market in terms of intraday. We're seeing some changes of behavior. You mentioned the last 30 minutes of trading. That's something I know over the years I've looked at the so-called smart money indicator, and I think that kind of ties into it. But also just what happens in the morning. Instead of gapping down and rallying throughout the day, a lot of days we've done the opposite. We start out higher, luring in some early buyers, some aggressive longs, and then we kind of sell off throughout the day. How much of this intraday stuff do you look at in terms of setting up your longer term expectations over the coming days, weeks, et cetera?
Well, I think what you really bring up, Jared, is a great point for retail investors. And that is, the people always talk about have a plan, et cetera, et cetera. And, the old Mike Tyson, you have a plan to get punched in the face. And, people may have a plan until the market moves against them. But I think what you have to really understand is we just talked about a buy the dip. And what it really leads well into is what is your plan for this trade? There are some trades I may make that may be for a very short amount of time, a couple of hours, a day or two. There are other trades I'm making where I'm saying, okay, this is a 60-day trade. This is a 1-year trade. It's a stock I want to invest in for a longer period of time. And so because of that, I want to get different prices on the way in. I think the biggest mistake too many people make is they're not sure what their investing timeline is. And by knowing that will help you understand at what point do you want to buy that stock. A couple of things that I've seen retail traders make mistakes. And by the way, when I say that, I always include myself because I've probably made any mistake 1,000 times more than other people have made, is make sure you know your time frame and what you're investing for, so to speak. And then the last part of it being, if you have 300 shares to buy, maybe you do 3 100-share trades rather than all 300 shares at one trade. You always want movement to be your friend, not your enemy. So if it starts to go down, you still have 200 more shares to buy. That's not actually a bad situation to be in. So I do think that your whole question around the buy the dip is really solved for most people by knowing what their time frame is with that trade going in.
Good point.
JJ, you mentioned people turning to Microsoft now instead of Apple in terms of buying the dip. Why is that?
I think that, if you look over the last couple of years, Microsoft has gotten a lot more, because of AI, I think more enthusiasm around some of the products they've had. Obviously, they're both cash rich, but Microsoft for many people, I think, is more of a steady stock, if you will. Whereas Apple in the last year or so, it used to be people bought Apple because they were just fans of Apple. I don't think you see that same sort of, we've seen the same for Tesla in the past because of either who the CEO was or because of their product. They had, just fans of that. And no matter when people could buy the dip on those stocks, they did. I don't think you're seeing that quite as much anymore as Apple's gotten more and more competition in the space they sit in. So people don't necessarily, you see more when Apple starts to move down of why it's moving down being a fault, not, oh my God, this is an amazing buying opportunity. So Apple's come to earth, if you will, in that sense overall. And Microsoft really is the sort of king of, okay, I want some stability. I want some security. That's the stock I'm going to go to for both.
That's really interesting. You said some words a few minutes ago music to my ears. Know your time frame. All right. That is a key thing. That is a key tenet of, in my opinion, of retail trading. You have to know how long you're expecting to hold this thing. And a lot of times day trades turn into long-term investments, and that's not necessarily the way to go. Talk to me about knowing your time frame and how to set that up as a trader.
Well, talk about mistakes you've made over time. I think we both know that there have been times exactly what you said. You're like, oh, I'm going to
I
make this
have.
trade for a day. And you look at a year later and you still got some crappy stock that you have a position in that you only were going to trade for a day. So I think that 100% people always talk about, what makes successful traders, et cetera. I think what makes you successful in anything is quite honestly discipline. And the biggest discipline in trading is being able to have your time frame and, more importantly, admit when you're wrong.
We are back, and this episode is brought to you by the number 10%. That's how much the Mag 7 as a group are down on the year, and this comes after a couple years of hand-wringing over market concentration and comparisons to the late 90s dot-com boom, which was eventually becoming a bust. But I guess I'll ask it again, or I'll say it again, because we are still in a bull market. We haven't seen forces that have even caused the S&P 500 to fall in correction here. So we've seen some rotation. How big, how important is the AI trade overall? Let's call it Mag 7, even though that's not perfect. How important is that to this bull market?
Well, I think it's incredibly important overall because it gives momentum and it gives people confidence to invest in other industries overall. I think what's really happened to the Mag 7 stocks this year, you talk about AI. AI in theory is awesome. But what we're finally starting to see is analysts say, okay, you've invested, hundreds of millions of dollars in this. And besides being a really cool search engine or a way for, if one of my buddies jokes, seventh graders to cheat on their exams, whatever really gotten out of it so far. I think we're just starting to really see how it can help businesses overall, and probably mostly how it can help the medical profession, which is the area I think I'm most excited about on what it can do for people there overall who may not have doctors to go to on a more regular basis, et cetera. But with that all said, the ROI has not been good yet. And I think companies are starting to be pressed on that. And we've seen it so many times in our careers, right? Where the hope of something really gets the stocks to rise. And now it's okay, where is the ROI? What is the actual plan with that? And I just think that's what we're going through right now. At the end of the day, the reason I believe this market can continue higher is exactly what we touched on. Everyone's talking about the bad news about how things aren't doing. Yet at the end of the day, the U.S. stock market, although other markets have done better so far than the U.S. this year, no doubt about it, I still think longer term is the best game in town.
And if you have a long runway, right, someone maybe my age, does it really matter that we're seeing some weakness in the Mag 7 right now? I know we got a lot of tech overweighted in people's ETFs and people's portfolios. But again, if I've got a long runway, how much does it matter?
Well, exactly that. It goes back to knowing what your time frame is. If you have a long runway, you'll always want to buy companies that have plenty of cash, which we're talking about the Mag 7. They are sitting on tons of it and have quality products, which they all do. Now, that's not to say you don't have to look at your account at least every quarter and say, is the reason I got into this position to begin with one that still holds true today? And don't be sort of lackadaisical about it. But I think that times like this last couple of weeks, we've seen some sell-offs, we've seen some bouncing around. That's just a time to take a breath or to really say to yourself, hey, I bought this stock for a particular reason, and now I can buy some more cheaper. Does it make sense to buy a little bit more? Because I still am a believer longer term for the same reasons I bought the stock to begin with. As I said, I don't think these stocks are necessarily bad. I just think that analysts are starting to ask the questions they should be asking right now. The old show us why we should continue to believe in this AI story. What are the longer term ROIs? What are the shorter term ROIs that we can continue to say are mile markers of progress?
we talked about Apple and also Microsoft with respect to the Mag 7 here. And I just want to stick with that because this is a disparate group of stocks, and we have a lot of different characteristics among them. You also mentioned Meta, and Meta is interesting because it had that 20-day streak. I've never seen anything like that in any stock or any trading instrument. It was up 20 days, and then it seemed to be down for about a week straight, and it got crushed in this latest tumult with everything else. But talk to me about some of these other names here. It could be Meta, it could be Tesla, it could be NVIDIA, which really hasn't done a lot lately either.
Well, NVIDIA hasn't done a lot, but I think NVIDIA right now is a stock that really just is similar to what crypto maybe was at the end of last year. NVIDIA is a confidence measure stock to me. When people are feeling more confident in the market, so you're going to see this variance, if you will, day to day in NVIDIA and how people come in and play it. If you watch the volumes on that stock day to day, they really are amazing. And you see a lot of the shorter term players playing NVIDIA in and out. So I look at that stock and I see one that that people are voting with their feet, if you will, but they're voting in a short time frame, very, very much so, more than probably any other of the Mag 7 stocks at the moment, where you're not getting quite as many longer term players. We see it in our activity every single day because you see it in the equities and you see it in the options. As for Tesla, this is one that I think because of Mr. Musk's role with Doge, et cetera, many people were like, oh my God, similar to what we saw in Bitcoin and some of the other crypto areas of, oh my God, the President Trump is in, he's going to support everything here. So this stock is going to go to the moon. Certainly did act like it at first. But now people are starting to question that also. And we've seen a stock that's had a really difficult time, particularly over the last 3 weeks or a month. And I think, again, if you looked at this stock the first 2 weeks of January, look at this stock now, you'd think it was a completely different story as a company, whereas the company's story hasn't changed that much. It's just been the momentum around what people believe.
JJ, we're going to pivot a little bit because now it is time for our Trade This Way option segment, sponsored by Tasty Trade. So you have brought a couple of trades, and the first one is in Apple. We've been talking about Apple and some of the fundamentals here. We just want to talk about it in the option sense. And I know you're looking to sell potentially the March 25th 245 call. Could you break this trade down for us?
Yeah. So, if you buy Apple and if it's a stock that you want to hold longer term, and as I look at Apple here, it's trading right around 235. And between now and that March expiration, it has an expected move of just around $10. One of the things I like to do when I do a covered call or I do an A options trade, if I'm going to be selling it, I want to sell it right near the outside part of its expected move. And so with the premium you're going to collect, it's going to put you there overall. When you are doing a covered call, one thing I want to make sure people understand, it's still all about buying the stock. I'm buying Apple because in that time frame, I believe the stock will at the very worst stay the same or go higher. I sell the call to enhance my return. That's the primary reason I'm selling my call. If Apple were to rocket up to 260 or something like that, I would not feel bad getting my call called away at the 245 number. And with the premium at the time, it was about $2.20. So again, I'm looking at 247.20 in terms of where my break even is. If the stock goes through there, great. I can buy the stock again. I can sell a put. But covered calls are return enhancements. Sometimes people will be like, oh my God, I would never do that. What if the stock rockets up? Personally, my biggest problem has not been that when I buy a stock, it goes rocketing up. And so I think for most people, that's probably not your biggest concern in a stock. But the reason I talk about it being if the stock goes up slowly, winner, chicken dinner. I do want to stress, though, yes, you do get the premium that protects you a little bit on the downside. But in my opinion, covered calls should never be looked at as a downside protection trade. You are doing it because you think the stock is at the very worst going to stay the same or go higher.
Sounds like a very important mental state to be in when you put the trade on. You also came prepared with an S&P 500 trade, and here you're using the current volatility to get long the current market, and this involves a put spread. So could you break this trade down for us?
Certainly. So this one is in the SPX. And so, the SPX is the S&P 500 cash index. I decided to use the SPX rather than the SPY to take away some of the assignment and exercise risk. It's a European style option. It means you can't exercise it until expiration day. And for people who's, get nervous about that, you don't end up with a residual position. So that's the primary reason I chose this trade overall. What I decided to do was the 55.75, 55.70 put spread. At the time, it was trading for about $1. So the first thing you may look at is say, why would I possibly trade something that's I can only receive $1 and can go to $5 overall? So, difference between the two strikes, 55.70, 55.75. So if it goes against me, I'm going to lose $4. The reason being, there's a very simple formula you can do in options trades. You can say, what's my real risk? And this one, the real risk is the market going to $5, difference between the strikes. But what's my actual risk? My actual risk is $4. Why? I received $1 up front. You can take the actual risk and divide it by the real risk or total risk, because the total risk would be the $5. $4 divided by $5 will give you 80. What that tells me is I have an 80% probability of making some money, 1 penny or more, as the only way you can quantify that on this trade. I very much like to make trades where even though I might not receive as much money up front, I have a really high probability of making some money. I always joke I want to be like the Pete Rose without the gambling of options trading, just a little bit every single day, and pretty soon it's added up to a lot of money over time.
Might even make the Hall of Fame.
JJ, if you're brand new to options trading, what's your biggest piece of advice?
My biggest piece of advice is to start as small as possible. That is one contract at a time, and I would really look towards spreads. Too many people just buy a call or buy a put, and the time decay end of it really does hurt them if they don't understand it. But again, the easiest thing in the world is to become a bigger trader. You will have enough pain and suffering for $100. You don't need to have pain and suffering for $5,000. As you're starting, you're just learning the mechanics. You're just learning about what's going on. Watch everything about it. Think of that as kind of being your tuition, if you will. You're going to learn. So learn with the smallest amount of money possible and take your time. This is a process. Very, very few people in the world were excellent at it as soon as they started it. You will learn it over time. And to your point, if you're just starting out, hopefully you're younger, and hopefully it is something that you'll pursue as time goes on. Best thing about it, the markets keep you humble every single day, which I absolutely love.